Hi. Okay, so here we are at the next topic, trading on centralized exchanges. We'll look at the types of orders, the fee structures. I mentioned that already in the first video, how certain fee structures promote volume manipulation. The most common is what we call wash trading, and also the sort of price manipulation that happens on these unregulated exchanges. So we're going to be just talking about the centralized exchanges, not the decentralized exchanges that are on the blockchain. These are much, much smaller, and they specialize in either wallet-to-wallet transfers or a few other things, but mostly it's just wallet-to-wallet transfers that these exchanges do. We're going to be looking at the big centralized exchanges like Binance or Coinbase and how they operate. So onboarding and offboarding refers to the loading up of fiat to an exchange once you've got an account. But it's not recorded on the blockchain. Only the, if I were to onboard Bitcoin to Coinbase, that would be on the Bitcoin blockchain. But if I were to onboard Tether to Binance, that would be on a blockchain, not quite sure which, because Tether rides on lots of different blockchains. And offboarding means to withdraw funds. So you open your trading account and you transfer the crypto to what's called the hot wallet, which is online. And then the exchange will transfer to the cold wallet, which is offline, and that makes the funds secure. But as we shall see at the end, with a lot of the hacks, they've occurred onto the exchange's hot wallets that weren't properly secured before the funds were moved to the cold wallet. When I moved fiat onto a crypto exchange, I used a bank account that happened to be in Estonia at the time. It was a long time ago when I did that. Okay, so offboarding means to withdraw funds, and there's lots of cases when the exchanges are hacked and the funds are stolen. So actually exchanges nowadays limit the withdrawals that you can make. So you can only withdraw a certain amount each day. And sometimes they stop withdrawals completely. Let's have a look at the types of orders. And a market order will execute immediately at the current market price. So if I say buy Bitcoin or sell Bitcoin, it's just whatever the market is at the moment. Now it could be I say, not that I would say this, but it could be I say sell 10 Bitcoin and the current market price that I can see is only for 2. So I'm going to sell, I'm looking at a buy order. The highest buy order is whatever the price, 10,000, but it's only for 2. So I take that, and then the next one will only buy at, say, 9,999. So the rest of my order is fulfilled at a lower price. So depending on the size of the order, it may not all be executed at the same price, of course. It depends on what we call the depth of the market. More commonly, we use limit orders. So you set your own price and other options. For example, a standard limit order specifies a price that you want your order to be executed. For example, if the current Bitcoin price is 9,000, a limit order could be to buy at 8,500, a certain number of Bitcoin, okay? Or sell at 9,500. A stop loss order is a certain type of limit order. If I hold Bitcoin and I want to limit the losses, say I'm holding Bitcoin, then a sell at 8,500 would be a stop loss, saying if it falls that much, just sell everything, okay? In addition, you can have good till cancelled, which means keep the order on until I cancel it. Immediate or cancel, which means if at least part of it is not immediately filled, then cancel it. But if part of it is fulfilled, maybe you can't fulfill the whole order at that price, but if part of it is, then you leave the order there. And fill or kill, it will only complete if the entire amount can be matched now. So here's a picture of the limit order book, which stacks up all the limit orders showing their volume. And the major exchanges of the Bitcoin spot order books can be viewed in a very nice video here. And let's hope that I can start my Google Chrome, which I decided to stop so that it doesn't interfere with my video. Here we are. This is bitcoinicity.org. So this is GDAX, also Coinbase is called GDAX on this old interface. It's Bitcoin against Euro. If I wanted to do Bitcoin against the pound, there are a few. Kraken does Bitcoin against the pound. So that's Kraken. If I wanted to do Bitcoin against the Japanese yen, Bitflyer does that. It's the main market for that. Not very active though, is it? But if I wanted to do, for example, Kraken against the yen or against USD, that's much, much more active. You can see these are the sell orders in the book. These are the buy orders. This is the line over the last day from 3 o'clock yesterday until 3 o'clock today. It's been hovering around $13,800. And this looks like a fairly normal order book. If I look at something like Bitstamp though, let's see what's happening on Bitstamp. No, these are all relatively orderly. I'll show you some order books that look completely different when we talk about price and volume manipulation. So the types of traders, well, first of all, every trade occurs between two parties. You've got the makers and the takers. So the makers, they put their order in the order book prior to the trade, and the takers places an order that matches or takes the maker's order at some time. So for example, a maker might have put buy at 8,500 into the order book. And I, as a taker, put a stop loss like sell at 8,500. And so when it reaches 8,500, I would take the maker's order there. So the makers are so named because their orders make the liquidity in a market by placing a buy order under the ticker price. So that's the maker who would buy under the ticker price. I wanted to sell under the ticker price, so I'm not a maker if I've got a stop loss order. A sell above the ticker price is a maker order. So if I wanted to buy, not now, but if I wanted to buy at a later date when, not that I would put buy at 10,000, I suppose I might put buy at 10,000, buy at 10,000, then I suppose I could be taking out a maker's order there. So they're called takers because they take out liquidity from either side of the order book. And for this reason, makers and takers pay different fees for their orders. Here's an example of the fees on Kraken. That was quite an orderly exchange, as we just saw. The maker fees are about anything between 0 and 0.16% of the amount transacted, whereas the taker fees are much greater, and it depends on the size of the order. This is in terms of dollars. So if the order is less than $50,000, then you pay larger fees than if the order is, say, between $5 million and $10 million. Now, conventional crypto exchanges charge fees on both sides, as we saw. The taker's fee averages about 0.25%, 25 basis points. The maker's fee is closer to 5 basis points. But hundreds of exchanges, new exchanges, Binance and others, are what we call zero fee exchanges. They hand all of the fees, sometimes more, back to the traders, in particular to the market makers, and sometimes also to takers. They pay people basically to trade on their exchange. in the form of an exchange token, usually, which you can only use on the exchange. And sometimes if you use the exchange token on the exchange, you get even lower fees or more refund of your fee. The purpose of this is to artificially inflate the volume. So that means that the exchange is going to go high on the ranking sites, at least the unadjusted ranking sites. So this type of fee structure gives rise to something called wash trading. Here's an article from July this year. Cleaning up crypto exchange wash trading will take global regulation. So it's been going on for years, 4 or 5 years, wash trading. I'm going to show you a video that was taken when Kraken did it. It doesn't do it anymore because they've been cleaned up by the US regulators, but lots and lots of others do. So there was a report by Bitwise Asset Management in March last year, presented to the SEC, showing that 95% of Bitcoin trading was fake volume. And this is because the SEC is thinking about having a Bitcoin exchange traded fund, and they didn't know whether the market was mature enough, but looking at the volumes of trades, it looks mature, but the problem is that it's fake. And how can it be fake? Well, a trader's got 2 separate accounts. We couldn't call them makers because all they're doing is trading against those 2 accounts. They place buy and sell orders against themselves repeatedly. So this just inflates the trading volume, but it doesn't move the price because it's buy, sell, buy, sell, buy, sell. And they do that because they get these fee rebates. So let me have a look at this video first here, and then I'll take to the Blockchain Transparency Institute. So this is a chap called Bitfinext, who's worth watching on Twitter and other things. So you can see that the sell and the buy and the sell and the buy, and the price is not moving. It's hardly moving at all, but it's going down a little bit there, but we've got sell, buy, sell, buy, sell, buy, exactly the same. There's a few real orders. Look, that's 16, or maybe that's 16 is coming as that's a different robot. These are just algorithms that are trading against each other. Okay. So the same volume of orders being buy, sell, buy, sell. There's one at 5 and there's one at 16. And the Blockchain Transparency Institute, which is also ranking exchanges. So it's actually a ranking site, but they don't advertise. They just have various news stories and reports. They actually do surveillance. They put on AI algorithms on exchanges to detect wash trading. So you can see this BTI market surveillance report from last year is a fairly standard thing in the industry. So exchange rankings by real volume, the Binance comes right down to 7 billion. It's still the top exchange. It's a massive exchange. We saw when we looked at that video of the hacks into Binance on Whale Alert, how big the Binance exchange is. And these are just the spot exchange. I'm not talking about derivatives exchange at all. That's the next unit, okay? The next topic. So another form of price manipulation is spoofing. And this happens everywhere. It happens on the S&P 500. It happens on COMEX, gold and silver. JP Morgan just got fined $920 million for spoofing on the silver market and other precious metals and stock futures. Spoofing is why the S&P 500, the US stocks, have just grown 400% since the banking crisis, whereas every other stock market in the world, including the Chinese stock market, has hardly made any gains at all in the last 10 years, despite the fact that GDP has been growing all the time. And it's all down to price manipulation on established exchanges. So it's not surprising that it exists on all the crypto exchanges. Less so, I mean, this is taken a long time ago when GDAX was, you can see here a big sell spoof and here a big buy spoof. So the sell spoof is designed to bring prices back up. You can see the last 24 hours of prices, there was a big fall. Probably, this one was winning, because what happens is you can see it's above the ticker price. And so the people who want to buy think, well, if I just raise my price a little bit, I can fulfill it. There's enough volume there. So, okay, I will buy it at a slightly higher price. And then before they know it, it's disappeared. It's taken off. So then they have to go even higher. So it sort of jumps back. It's like fishing. And the same thing here. That's a spoof on the buy side. So people selling here know that if they just sell at a slightly lower price, there's a lot of volume that they can take in their orders. But as soon as they try, the price jumps down again. It's a spoof. It's not. It's a sort of not. It's done, of course, lightning speed by a robot. So let's have a look at the video of this in action again.
A lot of them are just people enveloping the market, doing through a trading bot, and the whole strategy has a very low execution rate in general. Okay, I understand. And then there are the people that are, in fact, trying to push the market one way or the other by flashing orders, when in fact they're actually trying to do something else. I can say that the type of
I'm going to show you it happening, because I know that it will be happening now, particularly if I go to BitMEX. This is actually a different market, but let's just go into BitMEX. You can see it straight away. That's contract specification. Let's just do, sorry, I was just looking at the funding rate on BitMEX perpetual. Let's just do BitMEX, BTC. They call it BTC. Let's see if that takes me into there we are, here's the order book. So let's have a good look at here we are. You see that happening there, both sides. So look at these trades here. They're not actually too bad. There's massive amounts here though. I mean, okay, on the sell side, look, this is all stacking up. 137, 166, 101. It's obviously very, very fast. And when you look at the actual recent trades here, how much is actually being transacted? 12. Okay. Okay, there's 4,000 there. That's not too bad. 5,000 there. So yes, at the moment, okay, there's a big order for 1 million, 1.6, 1.7, and then it'll disappear. It'll go back down to the book, so you can't take it. You haven't seen 1 million, 19,000 was managed to transact 19,000, but nothing like the spoofing here. Look, so they're trying to bring the price down. Obviously, we've just had the US election uncertainty. We still don't know who's going to win. And a lot of people will be wanting to get into the Bitcoin market, probably through this perpetual, because it's 100% leveraged, more or less. You need very little money to put very, very large positions. Like, 2 million Bitcoin. How much is that at 13,000 a pop? Quite a lot, okay? Billions of this is just flashing. And so there's two sides battling it out. This happens all the time. All right, let's go back to, hang on. Take that off for now. Go back to my, another form of price manipulation is pump and dump. This is often done by early investors in initial coin offerings. What they do is they buy a lot of the token in the pre-sale if they can. And well, the pre-sale is always cheaper. as we know. And then they hype up the coin on social media. A lot of that was happening 1 or 2 years ago. So I kept, my nephews and friends were saying, "Oh, have you heard of this token? It's absolutely amazing. Look at the website. Look at the white paper," and all this sort of thing. And as prices rise, other investors are drawn in. I mean, I didn't do that because I knew about pump and dump. But the price rises more and more, and then what happens is that those people that have got the early tokens at a very low price down here, they hype it up, and when they collude, there's not just one of them, lots of them do it, and then they do a simultaneous dump when it gets high enough and take their profits. But of course, the people that have, the later investors that are suddenly left with a coin that they bought at 10 and it's then valued at 2. Okay, so again, I'm going to stop my video here. So what am I doing? I'm going to stop. Okay.